This channel is for educational purposes only. Please do your own due diligence before making any investment decisions. Hi, this is Joe Rabil with Invest Like a Pro, and want to follow up to a couple videos that I've done over the last month regarding log sheets and keeping track of your trades. Now, the fact of the matter is, you don't really know whether you're doing a good job trading unless you have a solid log sheet. But the problem is, if you don't have a plan in place, then you could be logging trades, but you don't really know if you're following your plan. So you have to have a plan. So I figured it was definitely worthwhile to spend a video going through and at least giving you some basic outline as to what to be on the lookout for, what to do. So let's go ahead and get into this. So we're going to go through creating a plan, and there are actually 9 questions that you really need to answer. It's really 8, and then you add 1 extra just and I'll explain that at the end. So if we're going through and starting this, I want to make sure you get what we're trying to accomplish. So you want to do about 50 trades in any plan or system before you actually know whether you've got something that's worthwhile. So that means you go through 2 series. You do about 25 trades, and you might tweak it a little bit, but you won't scrap it. All right, you'll tweak it and then run another 25 trades. And after the first 25, you should have a feel for whether you think this is right or it fits your personality. It's a good type of approach to the market for you. And then you might have to tweak it a little bit, and then you do another 25. And in reality, you're going to need to do about 100 before you know whether you have a really good system in place. So I wanted to start with that, but let's just go ahead and go through the keys. So the first question you have to ask is market selection, which means what stocks or ETFs or markets am I going to trade? What is the marketplace that I'm looking at? You can't just say I'll do anything that shows up. You have to kind of have a starting point. Now, you can do it in one of 2 ways. You can have a static list. An example might be using the S&P 100 list plus the NASDAQ 100 list, and you scrunch them together, merge them together, and maybe there's around 150 stocks, 160 stocks, something like that. So that's one way to do it. You have a static list, right, as your starting point. You don't want that to be too big. You could just use the Dow Jones Industrial Average depending on the type of approach you're trying to do. I would think that would be more for trading, swing trading, if you're going to use a list like the Dow Jones, as opposed to trend trading, where I'd want to use a larger list. And in fact, what I like to do when I'm trend trading, well, first of all, I go through thousands and thousands of charts and send out stocks to my subscribers. And obviously, those are stocks that I would consider to be potential trend trades. They can be used for swing trading as well, but in terms of looking at trend trades, I'd want to start with a big list and then work my way down. The other way you could do it is use a screen. You still have to go through an inordinate amount of stocks to really get good quality symbols to use for trend following. But you have to define what you're going to do. So you could say, I want this market cap. I want this stock a stock has to trade a certain amount of shares. You could say, you could define it by sector, but for the most part, I think you want to look for market cap, shares traded, maybe price above 10 or above 15 or something like that. If you're below $10, it's really hard to manage risk in single digit stocks. So just be aware of that. And then maybe, over $250, $300, $500, something like that. Maybe you X that off the equation as well. Both of those ends of the spectrum, I think, are a little bit harder to manage. Let's go to the next piece that you need to answer, and that's the setup. And so the question is what are the conditions that you need to enter? And these are the characteristics you're going to want to define that help you figure out what goes on your watch list. So you have a screen of stocks, or you're a subscriber of mine and you get a list each week. You have to determine what fits your plan, how you want to trade, and you take a subset of that and create your own watch list. All right, so the setup could be, if I'm doing, let's say I want to trade the next leg to the upside in a single stock on a weekly chart. So I'm looking for stocks that have strong momentum characteristics on their MACD, strong momentum characteristics on their ADX. And I'm looking for a pullback. And the pullback I'm going to buy using the timing on the daily chart. All right. So those are the characteristics that I'm looking for. I'm looking for a strong trend on the weekly with a pullback and a daily chart that's probably showing a counter trend to, so it would be kind of turn to the downside. And obviously I do a lot of this in the course. I go into a lot of these details for this specific setup. But so I'm looking to play a pullback on the weekly. I'm using the daily to help with that. Those are all the characteristics I'm looking for. I've got to have that all listed and what has to take place. What do I consider a setup? All right. Again, they can take slightly different form as long as you have it written in your plan. You could say the 18 on the daily chart has to cross down below the 40 and price has to be below both. Or I need to have the MACD come back down to the 0 line while the two 18 and 40 are coming closer together. You know, something that, or I can draw a trend line on the daily chart because I've made a lower high and a lower low. Those are the types of conditions you want in place on the lower time frame. And you're also going to want to have conditions on the higher time frame if you're trading the way I do. Now you can do a single time frame setup, maybe using like RSI, using the RSI 20 and 5 if you want, but I think the 2 time frame setup is going to give you, I think, a lot of opportunities. What you need to define is what time frames you want to trade, and that is all a part of the setup as well. Now, I didn't put that down on here, but the reality is that you have to figure out which time frames are going to be traded, all right? And that goes into the setup. You have to put all that detail into the setup. If you want to trade one setup in multiple time frames, and you put that into your plan, all right? You can't just go willy-nilly, oh, I see it on a 2-minute chart or I see it on a monthly chart. I mean, you can't do it that way. You have to determine in advance which time frames you're going to trade and you know, what the setup is. All right. So next thing is the entry and the trigger. So in my course, obviously, I go through I have 4 different triggers that I like to use. I also have one kind of standalone trigger that can be used in any circumstance, as I've talked to my subscribers about. But you need to be really specific about the trigger and the entry. And the reason that you have to be specific is when the market is moving quickly and there's all kinds of action taking place, you will be drawn in by your emotions if you don't have a well-defined entry and trigger. The other reason why this is so important, having a clean setup and a clean trigger, is that you don't really have a way of testing whether your system works if you don't have an approach that it can be defined, right? So we have to be able to define those things, and so this is where you would do that. This is the question that needs to be answered. Okay, let's look at the next question, and that's the initial stop. So once you've entered the market, so you have a setup. Let's say we'll stick with the same plan. We've got a weekly chart that's rallied up. It's pulled back towards its 18 MA. The daily chart has formed an opposing trend trigger, and you get a clean setup. And let's call it a trigger 2. It goes into the zone, comes out, turns back up, and shows the signs that you're looking for. You put in your entry, you're long the stock. Well, you need to figure out where you're going to place the stop. All right. Now, that stop is going to help you define how many shares you're going to do. So you need to know all this in advance. I prefer to have it in a spreadsheet where I plug these numbers in and it spits out how many shares to do. I'm going to go into that in a second. But the reality is we need to have an initial stop. We need to be consistent. Always do the same, use the same approach. I use an ATR approach in my course. I explain how I go about using that as a barometer for how far the stop should be. So that's a good starting point. You want to make sure you have an initial stop in place. The next thing you want to be doing is a trailing stop. You have to define this in advance. You have to know where your stop's going to go, and you have to know how you're going to trail a stop, meaning if a stock starts to move in your favor, how are you going to raise? You can't just leave leave the stop where it is. You have to trail a stop. You have to have some method for trailing the stop. And one thing I would caution you about, and goes from my experience when I first started, is I used to trail a stop way too quickly for the type of pattern I was looking for. So I was looking to play a strong trend that had real potential, and I would trail my stop too quick, and I'd end up getting out. In a lot of cases they would be profits, but the problem is that I was playing for a bigger move, and I never gave it enough room. I was playing for a bigger move, and I wasn't giving it enough room to really hit its full potential. So you need to be careful about that. But again, you have to have it all defined in advance. I like to use my ATR method for this trailing stop in conjunction with prior lows as well as moving averages. And I think if you follow some kind of a method like that, it's going to prevent you from being emotional. A lot of times, if you're watching stocks trade, you'll see a big reversal or something like that, and it gets you thinking, oh man, and it's happening intraday, right? And you're like, see it in the middle of the day, and the bar looks really ugly, and you're like, you know what, I'm just going to get out and take a profit. But by the end of the day, it comes back, and the bar doesn't look that bad, it wasn't in your plan. It just because you have a reversal bar, if you're trading a weekly chart and you get a pullback and then you get a move to the upside and you get the trigger, you're moving up, and the daily chart has a reversal bar. I mean, we're trading off the weekly, not the daily. So you got to be really careful, or at least we're playing the setup on the weekly, right? I know we're using the daily to manage the risk, but you got to be very careful about getting shaken out by small things that are taking place on a daily chart when you're really trying to follow the weekly trend. So these are kind of the keys, and I'd be very careful about using momentum as an exit strategy unless you're trading shorter term. All right, as far as your trading method is gotta coincide with the type of approach you're going to do. So if you're swing trading, you're going to have much more aggressive approach to taking targets. If you're trend trading, you're going to have a less aggressive approach to taking targets and a more a wider or a lax way, a way where you're giving a stock enough room to trend, and its normal volatility will not take you out. So all of these need to be covered in your plan. And then obviously we want to have a taking profits strategy. How are you going to take profits? Well, I kind of define this again in my approach, but in my course, but you can do this a number of different ways. You can use prior resistance. You can use multiples of your risk, which I like to do, which is again based on its average true range. So there's a lot of different ways to manage this. Now the key is, what type of trade is this? Because if you're swing trading, if you're short-term trading, you tend to want to take profits and look for expansion to just get out. Whereas if you're trend trading, you want to have some method of scaling and trailing. And those ways of doing that could be, you could take half off at 1-to-1. You could take a quarter off at 1-to-1. You could take a quarter off or half off at 2-to-1. There's a lot of different ways to handle that. It's got to fit your personality. It's best if you can go back through prior trades and see which would work. We did that over a 10-year period to figure out some of these strategies that I use in the course, and they're different depending on whether it's a weekly daily versus a monthly weekly. So all these have to be in your plan. So if I have a monthly trade and a weekly trade, monthly weekly type combo, I'm using a different taking profit strategy than I am when I'm using, and a trailing stop method is different than I am if I'm using a weekly daily, or especially if I'm using a daily hourly. All right, and then we have to know all of these other things before we can determine your position sizing, which is how many shares you're going to do. You have to know how much risk you're willing to take in any specific stock. Typically, I like to recommend around 1% of your equity to your stop. That means if you enter a stock, so let's just say you enter a stock at 50, all right, and your stop is at 49. All right, just to keep things simple, and that's $1. All right, you're risking $1 from from your entry to your stop, and you have a $50,000 account, well, you can buy 500 shares because 500 times 1 is 500, and that's 1% of a $50,000 account. So you just have to have this calculation. And again, I like to have it in a spreadsheet so I don't have to do a whole lot of thinking when I'm looking to enter. Van Tharp refers to this as R, and you're going to want to know what your R is. It goes back to what I was talking about with the log sheet and all that. So you have to make sure you have this defined and that you're consistent with it. You can't take huge trades sometimes and risk like 4 or 5% of the account, and then other times you don't like the trade as much, even though it meets all your criteria, and you risk 1/4%. You need to be consistent with how much you're going to risk. The other things you need to calculate or put into your plan when it comes to position sizing is you have to determine how much you're willing to risk by sector and also the total portfolio risk. And that is going to be determined for me by the type of market environment you're in, right? If you're in a bear market or you have a very highly volatile market, you might not. So if you have a really, really volatile market, it's hard to do a lot of long-term trades, but you might be doing some weekly dailies. You might have more of those. So you don't necessarily have to define that part in your plan. But what you do need to do is determine how much you're going to risk in a total portfolio, let's say in a bear market versus a bull market, also by sector for sure. Like right now, we've got tech stocks really the only things trending right now. So are you going to put all of your stocks in the tech sector? Are you going to you're going to put everything in your portfolio, let's say you do 10 stocks, risk 1% in each. You're going to be fully invested at that point. If you do it that way, let's say, depending on how much you risk, you might not be able to do 10 stocks, but you do every single one in the tech sector. Now, that might be the right thing for some people and the wrong thing for others. All right. And so you have to determine what you're going to do in those situations like we are right now. I typically recommend having some form of restriction so that I can't do that. I don't necessarily, that's telling me that the market's probably not in a really strong position if only one sector is giving me ideas. All right. And then finally, so those are the 8 questions. Then finally, you're going to add an additional question, and that is, do I want to have more than one system? And this is part of the reason why in my course I added the swing trading component, because the original course, the foundations course, is based on trend trading mostly. And it's not like you can't swing trade off the original course. And I've obviously proven that by showing you this swing trading approach. But what ends up happening is you create a different equity line, and it'll smooth out your overall equity line if you have more than one system in place. So you could have a reversion system or a counter trend system that's going in conjunction with a trend following system. And over time, you're going to smooth out your results. And I think this is another thing that you're going to want to answer. You're going to have to answer this question. Now, it's not a bad thing to just start with one system, but you have to recognize that most systems will only work in certain market environments. So like a trend following system, a long only trend following system in a bear market is going to, probably not do as well, correct? But if I have a long only trend following system in a bear market and I'm doing a swing trading, like a compression-based swing trading approach, now all of a sudden I'm probably making some money in my swing trades, compression-based, quickly, that's smoothing out my overall returns. All right. So anyway, these are the types of questions I would recommend you going through to create a plan so that you can do a log sheet and put in enough trades so that you have an idea of whether you have an approach that will be successful for you. All right. Let me know if you have any questions. Thanks.